you anything. ZAMA is the brainchild of Prashant Naik, who is an event manager who runs a company called Pratham Events. And he regularly organizes this workshop to bring some very relevant information that could be very, very useful to you for your career, for your personal reasons. I have with me the panelists. I'm very, very happy to welcome the panelists one by one. We have with us Vionel D'Souza. Hello, Vionel. Thanks for coming and thanks for gracing this webinar.
Thanks, Sandeep. I welcome all the participants for this session.
Vionel, we can't hear what you're saying.
No, thanks a lot, Sandeep, and I welcome all the participants for this session.
Great. So let me quickly introduce Vionel to all of you. He is an investment professional practicing in the city of Mangalore. He's an adjunct faculty at AIMIT, St. Aloysius College. He's got work experience in JP Morgan Chase, and he's also interned at Qualico and Aranaha. He's a BCom, he's a commerce graduate and an MBA from St. Aloysius College, Mangalore. He's also very passionate about interacting and discussing with young minds in the idea of money management and also on tackling procrastination, which is a threat to one's success, but never usually taken very seriously. He's also an introvert by nature, but he loves to speak in public, so he's going to be speaking today. And all thanks to the Mangalore Club of Toastmasters International that Prashant has, that Vionel has become such a smooth talker. Well, welcome again, Vionel.
Thanks, Sandeep.
And I'm quickly going to add another panelist. Do we have Elston here? I don't see Elston, so Prashant, you might have to add Elston because I don't see him.
Elston is there.
Under what name?
Elston Neil Menzies.
Oh, yeah.
You have to promote him.
Okay, I'm going to promote to panelists. Okay, so our next guest, of course, the panelist is Sapna Shenoy, also from Mangalore. Let me quickly introduce Sapna to you. Sapna is a personal investment services professional specializing in personal financial planning. She's a freelance trainer specializing in personal investment management, financial planning, and money management. She's a graduate, commerce graduate from St. Agnes College, Mangalore. She's also done a PGDIM from St. Aloysius, Mangalore. And she's been an intern under mentor, Mr. Gerard Qualico, investment advisor, partner, Qualico, and Arana. She's worked in the mutual fund industry, worked for AMCs like Franklin Templeton Investments, and also HDFC Asset Management Company. She started her financial advisory firm in the year 2016 and has been teaching at various educational institutions and at companies, regularly organizes sessions at corporate campuses on personal financial planning. She's also an active member of the Mangalore Toastmasters Club. Welcome to the webinar, Sapna. So happy to have you here.
Sandeep, thank you.
Great. And we've also got Elston. Elston, are you with us? Can I hear you?
Hi, Sandeep. Can you hear me?
Yeah, very good. I can hear you. Yeah. Let me take the privilege of introducing you to the audience today, Elston. Let me quickly. Elston is a personal financial services professional as well, based in Mangalore. Very passionate in this field. He's got 12 years of experience with the financial services, and each 4 years have been successfully practicing as a personal financial services professional. And he's conducted various investor awareness programs in many locations, more than 10 locations all over the country. Welcome, Elston. Nice to have you here.
Yeah, thank you, Sandeep. Thank you.
And finally, I'm the moderator for the session. My name is Sandeep. I'm based in Bangalore, and I run a personal financial planning firm myself. It's called Ashika Financial Planners. And most of you may already be knowing my background. I have been working in multiple banks, State Bank of India, HDFC Bank, and ICICI Bank. I've worked with them, and eventually started my own financial planning firm called Ashika Financial Planners, which is based in Bangalore. Well, without further ado, let's progress with the webinar. I am told Sapna would like to give a quick presentation on what we're going to talk about today, following which we would have some question and answers. Some of them I would be taking from whatever the participants sent to me. And after which, if you'd like to speak, I can also unmute you and you could speak and direct your questions to anybody in the panel. If you can turn on your camera, that would be nice. Right, over to you, Sapna.
Sandeep, 1 second.
Okay.
Elston's been promoted to talk. He should be promoted to panelist, not just allowed to talk.
Okay, I'll go ahead and do that. Sapna, you can start with your presentation.
Yeah.
Sandeep, I have been disabled to share the screen, so could you please allow me? This host disabled participant screen sharing.
Okay. Okay, I'm going to go ahead and do that. Can you start talking about your presentation when I go ahead and do that?
Sure. Okay, so good evening, everyone, and I welcome all the participants to our session. Now, about personal finance, it's a vast subject, and so that we have a good framework on what aspects of personal finance we are going to deal with today. We have a short session before the panel discussion as such. It's going to be very short and it will give you a good idea about do's and don'ts about personal finance as such. I think I'll have to wait for the screen sharing. Okay. Today we are going to deal with discuss about personal finance in relation to the current scenario. As we all know, the COVID-19 and the lockdown. Now, things are very unpredictable and uncertain, and that is what we are going to discuss about.
Right, Sapna, I have allowed you to screen your share your screen, and you could go ahead and share your screen.
Yes. Okay, as I was telling you, we are going to discuss about personal finance in relation to the present scenario, that is COVID-19 and the lockdown. Things are very uncertain and that is our reality. Things have drastically changed in our lives, not only in our personal lives, but also in our personal lives. There were both upsides and downsides. Now let us not get into the downsides because I know the list is never going to be ending. Let us be positive and focus on the positive sides. Now, three important things happened. Basically, we are more comfortable with technology. We embrace technology like never before. And secondly, we are no more bound by our geographies. And thirdly, let's be honest, if it wasn't for COVID-19, we wouldn't be here joining an online session on personal finance. Now, as humans, we like predictability and certainty. And that is what gives us confidence. But there is, on a doorstep, there is uncertainty today. Let us not forget that uncertainty was there even in our past. Okay, in the month of March, usually we look forward to summer vacations. We plan for summer vacations, but what happened this time was we were forced to plan about our survival. Forget about thinking about our future. We were thinking about, we do not even know what July looks like. Now, who better than Mr. Warren Buffett to talk about or to explain us about uncertainty? Mr. Warren Buffett is considered to be one of the most successful investors in the world. He says, just a minute. He says in the
Sapna,
20th. Yes.
I think your mic is shaking too often, so
Okay.
for disturbance. So maybe you might want to
Am I audible now? Is it all right?
It's clear. It's
Can
clear.
you
Yeah.
hear me?
Yes. Yes.
Okay. Okay. So let me quote what Warren Buffett says about uncertainty. In the 20th century, the United States has endured two wars. Sorry about that. Just a moment. In the 20th century, the United States endured two world wars and other traumatic and expensive military conflicts, the Depression, a dozen or so recessions and financial panics, oil shocks, a flu epidemic, and a resignation of a disgraced president. Yet, the Dow rose from 66 to 11,497. Now, Dow Jones is the US stock market index. Now, Warren Buffett? What is Warren Buffett trying to tell us is crises happen all the time. We have had crisis all the time, but every time there is a new crisis happening, we feel it is end of the world. Just take the very recent times. A decade ago, 2009, we had the global financial crisis. Now we have the COVID crisis. A decade down the line or a few years down the line, we are going to have another crisis like this. And despite of all these crises, United States stock market managed to grow. Now here's a data about it. Look at the graph. This graph shows the value of $1 invested in US stock market. That $1 was invested between 1775 to 1800. That has now managed to grow to more than $1 million in just about 200 years or 2 centuries. Now, if that is about US stock markets, what about our Indian stock markets? Here's a chart that shows the daily movement of Sensex values. Now, Sensex was started on 3rd of April 1979, and you can see what I want you to observe is the blue line there. You can see it goes up and down, which states that Sensex is very volatile. But more importantly, what I want you to observe is not the volatility. If you can see, it's an upward curve. The blue line is going upwards, which shows that in the past 40 years, though India has seen wars, we have had assassinations of prime ministers, and we have had economic crisis in the past 40 years in the country, still our stock market has managed to grow. Now, why am I talking about stock market and why is stock market important? It is important because in the long run, it represents our economy or it mirrors our economy. At this point, I would quote my mentor, Mr. Gerard Gulasso, who always says, there are zillion things in life which we cannot control. And there are things in life, there are only a few things in life which we can control. So we need to focus on those things which we can control. Now, in our financial lives too, we need to exercise this right in relation to the inflation monster. Just like we have the COVID monster, we cannot see it, but it exists, and today it is controlling our lives. Similarly, the inflation monster, we cannot see it, but if we ignore it, tomorrow the inflation monster is going to control our financial lives. To know more about inflation, I would show you a short video. This is actually a Thai ad about a small boy who is saving and investing, and shows and it tells us about how the inflation monster can damage our financial lives. I request your honor to please share that video with the participants.
Can you see it?
Yes, we can see it. Please play it, Your Honor. We are not able to hear it.
นี้มีแววอัจฉริยะผู้ที่จะคิดค้นโลก
ป้าซื้อลูกชิ้นลูกหนึ่งได้ไหมครับ อ๋อ ไม่ได้ จะอิ่มเหรอ
ค่าเงินลดลงทุกวัน เก็บอย่างเดียวไม่พอ
I'm sure you enjoyed that video and now you know how inflation can damage our financial lives. Now that you know about inflation, let us now discuss about how to manage our personal finance. The first step is to assess your financial situation. For this, you need to ask 3 questions to yourself. The first question is, how much are you paying your cost or servicing debt? What are your EMIs that you pay every month, or what are the loan repayments that you have every month? Now, the best situation, if you want to have a healthy financial life, you should not be having any debt. Having been said that, in today's time, it is not possible for us to manage doing it. So, please stay away, especially from 2 kinds of debts, that is credit card debt and personal loan. And when it comes to housing loan and education loan, since you will be building assets because of these particular loans, to an extent it is okay. Now, how much EMI or how much repayment of loans in a month is okay? You should see to it that your EMIs do not exceed more than 25% of your income. Let me give you an example. If your income in a month is 40,000 rupees, 10%, 25% of that is 10,000 rupees. So your EMI, total EMIs and your loan repayments put together should not be exceeding 10,000 rupees. The second question, what you need to ask yourself is, how much are you paying your current self? What are your basic normal living expenses? Now, you don't need to use those fancy apps or spreadsheets to calculate this. I'm sure post lockdown, most of us know what are our basic needs and what are our luxuries. To keep it simple, roti, kapda, makan, and in today's world, internet is our basic requirement, and rest of them, everything else without which we can live, are all the luxuries. Now, how much is okay to be spent from our monthly income? To have a healthy financial life, we should not be spending more than 50% of our take home income. Quoting the same example of earning 40,000 rupees a month, you should not be spending more than 20,000 rupees a month. The third question you need to ask is how much are you paying your future self? How much are you saving and investing? And here you need to divide this into three segments. The first segment is emergency fund. Ask yourself, are you prepared for an emergency in your life? What if you lose that job or you have to close that business that you are running? What if there is a natural calamity or you have a personal crisis in your life? What if that income stops coming in from tomorrow? Will you be able to pay your kids' school fees? Will you be able to pay all your bills? Will you be able to continue feeding your family with all the comfort that is required? So ask yourself this. And this is the very reason why every individual compulsorily should have an emergency fund. Now, how much emergency fund should an individual have? There's a simple calculation. You should have 12 months normal living expense. Giving, for example, in case your normal living expense is 25,000 rupees a month, multiply it into 12, it becomes 3 lakh rupees. So that individual should have at least 3 lakhs to 4 lakh rupees of emergency fund. Now, where do you invest this money? Now, when it comes to an emergency, you should see that returns on these kinds of investments are not important. What is important is the safety of your principal, that is the invested amount, and liquidity, which means you should be able to withdraw this or convert this asset into cash with least amount of loss on your value and time. The next segment is general investment fund. Now, most of us have a lot of dreams and aspirations, but fortunately or unfortunately, these dreams and aspirations, for most of them, there is a monetary element attached to it. Let's be realistic. We cannot achieve everything in life. For example, like most of us would want to go on a world tour, but how many of us actually work on going on a world tour? This is because most of us have other priorities in life. It can be owning that house or building that house. It might be children's education, our own retirement, or it can be even starting our own business. Now, unlike the emergency fund, here we can actually plan in advance to reach our dreams and aspirations. And how much do we invest towards this general investment fund? As a thumb rule, we should be investing not less than 15% of our monthly take-home income. Again, quoting the same example, if this 40,000 is your monthly income, then not less than 6,000 should go into your general investment fund to fulfill all your dreams and aspirations and the priorities that you have in life. Now, where should you invest? You should invest it in something called as a hybrid mutual fund. Another name for it is equity and debt mutual fund. The third segment is the retirement fund. Now, if I ask you, when should you start planning for your retirement, or when should you start saving and investing for your retirement? If you tell me that is when I decide when I want to retire or when I'm close to my retirement, then the answer is absolutely wrong. You need to start planning for your retirement, and this might surprise you. You need to start the moment you start earning. So if you are already earning and if you have not yet started investing for your retirement, then you're already late. How much should you invest towards your retirement fund? As a thumb rule, not less than 10% of your take home. If your monthly income is 50,000, then directly 5,000 rupees, which is the 10%, should be put into the retirement fund. If you are earning 1 lakh, then 10,000 rupees should go into your retirement fund. Where should you invest this money? In something called as a diversified equity mutual fund. Now, there are a lot of avenues of investments, and you might be wondering, why am I favoring mutual funds as such? I am not favoring, but there is a strong reason why I am talking about mutual funds here. That is because Out of all the avenues of investments, there are only two investments that beat inflation in the long run. In long run means anything that is about 10 years. And those investments are, first one is the real estate. Okay. Now, as a common investor, not being a professional investor, as a layman, real estate can be very expensive. It is unregulated and it can be highly expensive when it comes to maintenance. Also, it is very illiquid, which means in case we urgently want money, we won't be able to sell it immediately. So there are more demerits when it comes to real estate than the advantages an investor would have. The next one is the stock market. Now, coming to stock market, it is very liquid and it is also highly regulated. But the problem here is, as laymen, we may not have the expertise to deal with stock market or to choose which company to invest in or to make that portfolio of a good make that portfolio of good companies to invest in. Now, if you tell me I could hire a stock market expert to do that for me, what happens in the market is 99.99% of the times people are not investing in the stock market, they are actually speculating, which means they're actually gambling with your money by investing in the stock market or buying those stocks and not actually investing it for the long term. So as a layman, as a new investor, though these two investments are very good, it may not be actually practical for us to invest here. So what is the alternative? Mutual funds is the alternative. And what are mutual funds? Mutual funds are not an investment. It basically is a platform. It is managed by professional fund managers who invest your money in portfolios of mutual funds. Either it can be either debt mutual funds or equity mutual funds. And the beauty about mutual funds is that everybody can afford it. With just a small amount of 500 rupees, you can start investing in mutual fund every month in through something called as SIP, systematic investment plan, which is nothing but similar to your RDs or recurring deposit in your bank account. Now, since most of us Indians, most of us are obsessed with investing in FDs and gold. So you might question me, why not invest in FD and gold? Now, if you can see the chart here, the green line shows the returns from Sensex, the blue line shows the returns from FD, and the red line shows the returns from gold between the tenure of 1980 to 2019. And if you can see, the fact about returns from FD and gold is that they do not beat inflation in the long run, unlike stock market and real estate. But it is important to look at gold and FDs because the principal is always safe when you invest there, and it is also highly liquid, which means when you urgently need your money or if there is an emergency, you can quickly withdraw that money. So the features of these investments of FD and gold matches the requirements of our emergency fund. So by all means, for an emergency fund, you can invest in an FD. And when it comes to gold, see to it that you do not invest more than 10% of your savings. Now, when you assess your financial situation, in case you are not spending more than 25% on repaying your EMIs, and if your expenses are 50% of your take-home income, and you're saving and investing about 25% of your income, your financial status is just satisfactory. In future, you might face financial problems. But in case you do not have any debt, you are saving and investing more than 50% of your income, and you're controlling your expenses to less than 50% of your take-home income, then your financial situation will be excellent, which means that you will attain financial freedom in the future. Which means to say that financial freedom means retirement. It does not only mean retiring at the age of 60. You might be able to retire even before that. So that was all, and I hope it gave you a framework on what we are going to discuss further. I now hand it over to the moderator, Sandeep, to continue with the panel discussion. Thank you.
Thank you very much, Sapna, for the presentation. I think now we will have the discussion between all the panelists. So I request Elston and Yonel also to start their videos. I'm going to start my video as well. All right, so welcome, guys. Thank you very much for the crisp presentation once again, Sapna. I've got some questions that I want to throw open to all the panelists. Whoever would like to take the question can just start answering. And I want to know, quite a few participants here are not so familiar with personal financial planning, and this is an initiative to help them understand that. So how exactly should one go about personal finances? Is there any framework in place?
Is it for a particular panelist? Or
Yeah, Sapna, you could start with it.
Okay. The short session was about the framework so that we have a clear idea about where to start from. First, assess your financial situation. Like how much are you spending? How much are you earning? You start right from there before you get into where to invest. So first, you should know where you're spending and where your income comes from and where your expenses are going. You start from there.
On yeah, go ahead. You want to say something?
And then you have that. You need to ask where your savings and investments are going. Have three categories: emergency, retirement, and the general investment fund, and you will be sorted.
All right. I have a question on emergency fund, and I'd ask this question to Vionil. Vionil, what exactly do you mean? Like how much exactly do you think you should set aside for the emergencies? Of course, the presentation also spoke about it, but you could also probably give your viewpoints.
Sure. Am I audible?
Yes, you are.
Okay. So when it comes to an emergency fund, let me just share an experience. See, before COVID, we used to convince people you need to have an emergency fund. And these days, we really do not have to convince, because the problem is we are quite well versed with emergency now. So when it comes to an emergency fund, the thumb rule is, see, let's say your expenses are like 40,000 per month. It is advisable that you have at least 12 months of your living expenses. So that comes up to around 5 lakhs per year. So set aside 5 lakhs per year. Now the logic is, why do we have to have at least 12 months of your living expenses? It's like at least for 1 year, even if there is some emergency comes, I do not really have to worry about it. And that's the entire the point of having at least 12 months. It doesn't mean that you'll have an emergency only to the extent of 12 months, but it's important to have something than nothing in such situations. And when it comes to an emergency fund, I would like to say that invest in an avenue which is very liquid, which is very safe. The best example is a bank fixed deposit, but there should be minimum loss of time, minimum loss of value when you're withdrawing it. Or another best avenue for people who are in the higher tax bracket is a liquid mutual fund. You will have an access to it as and when you want the money. Maximum within a 1 day working notice, you would have the funds back into your bank account. So just to summarize, when it comes to an emergency fund, have at least 12 months of your expenses set aside for emergencies, and you can build this over a period of, let's say, 2 to 3 years. So in 2 to 3 years, you should be able to set aside funds for emergencies and top it as and when your expenses increases. I hope I've given that clarity on an emergency fund.
Right, Elston, so I'd like to ask you something about retirement. Sapna had given her opinion some time back, and I'd like to take your opinion as well. How important is retirement, and how much do you think you should save towards retirement, and where exactly you should invest, and what's the ideal age to retire?
Retirement is more scarier than COVID. Okay, because once you retire, your health will not be good. So probably in the first 5-7 years, yes, you may be able to get a job and things like that. But once things go bad, let's say you're 68, 70, even though let's say you do not have the money, you will not be able to work anywhere. So that is very scary. So when do you work is your first, say 30, 35 years. Let's say once you finish your graduation or your degree, say by probably around 24, 25, if you start working. So you get only about 34, 35 years for you to accumulate that money. So after that, it's only the spending phase. So even if you want to work after that, you may not be able to work. So that's why I said it is more scarier than COVID. How much do you save and when do you save? Let's say you start early, you can just put aside 10% of your corpus. Say, let's say you earn around 40,000 per month. You put aside 4,000 per month. How much is that? Will that pinch? Say from 40,000, you take 4,000, you still have about 36,000 for other things as such. Is that enough? It is more than enough. I'll give you a scenario of what happens if you delay by 1 year. Okay. Let's say instead of 24, you start at the age of 25. Okay, just 1 year difference. How much do you think you will lose by delaying by 1 year? 1 year is about 12 months. Let's say your SIP of 4,000 will be about 48,000. How much do you think you will lose in your corpus? You won't believe, you will lose around 11% of your corpus because you delayed that first 12 months of your investment. So please do not delay on retirement. Retirement starts the day you start working. Yeah.
If they start 1 year later, then
they lose 11. They lose
more.
about 11% of their corpus. Yes, yes, Sandeep.
Yeah, they might have to invest much more to be able to get the same kind of returns as they would be getting if they had invested 1 year earlier.
Yes, yeah, but for that they'll have to sacrifice on their spending.
Yes.
Okay.
So the younger you start, you can start with a smaller amount, and as you keep growing in your career, you can keep increasing the investments as well.
Yes, that's right. So let's say as and when your salary increases, so let's say it becomes 50,000, you make it 5,000. So review it once a year. So I'm sure you'll have a increment in your salary and things like that. So keep increasing it by just 10%. So let's say you have a salary of 1 lakh, just put aside 10,000 per month. So that is good enough.
So we have a relevant question at the moment. So I'll take the question right away. It's from Vilma Vaz. She wants to know what's the best way to invest for retirement and where to invest. If FD is not the best way, then which is the best way? So yeah, go ahead, Elston. You let me know what's the best place to invest for retirement.
So basically, it's the time horizon. So when I was talking to you about equity or equity mutual funds for retirement, yes, you need to have at least 10 years and above. So not below 10 years. So if Vilma is still, say 10 years away from retirement or more than that, then equity or equity mutual funds are the way to go. And when I talk about equity mutual funds, I talk about diversified equity. I talk about index funds. So you have the Nifty index funds, you have the Nifty Next 50 index funds. So you can look at that. So it depends on the time horizon. So if someone is closer to retirement, then probably let's say less than 5 years or less than 10 years, then they'll have to look at balance funds or hybrid funds. Less than 5 years, they'll have to look at bank FDs or debt mutual funds as such. So it depends on individual to individual. I was talking equities and equity mutual funds are for 10 years and above only, because there is a risk that is involved, and to overcome that risk, only time will help.
Just to add to what Elston has spoken, we are not discouraging people from not investing in real estate and stock market directly. If you are an expert, if you have all the information, and if you can go ahead and do your investments and manage it well, please go ahead and investment. But most of us will not be in a position to do that. That is why the alternative is the mutual fund. And another reason is that it's mutual funds are affordable for everybody. You can, in case we are able to save and invest only a few thousand rupees, how can we manage buying the real estate or investing in the stock market? So the best option is the mutual fund.
We hear quite a bit about equity mutual funds, and just want you, Sapna, to explain in very layman terms what is equity and why should someone invest in equity when we quite often keep hearing about people losing money in the stock markets.
When it comes to equity, there are two things. Just like how a gun has two qualities. It can be either bad or it can be either good. You can you can use a gun to harm yourself, and you can use the same gun to protect yourself as well. Similarly, equity also has two qualities. You can either invest in it or either you can speculate in it. Speculation is nothing but gambling. Now, what is equity? When you invest in equity, let me quote you an example of Infosys. Okay, when you buy a stock, buy one share, you will become a partial owner of that company. If you own one share of Infosys, that means you are partial owner of Infosys, which means you and Narayan Murthy are now partners. So what if you want to be partners with Mukesh Ambani? You have to invest in equity. So equity is nothing but, for most of us, what we look at equity is the trading. You buy a share, you sell a share and things like that. But in reality, you can create wealth in stock market only in the long run. Long run is minimum of 10 years. If you can't invest and hold for 10 years, don't get into it. Have I answered your question?
Yep, of course. And Vionel, I've got a question for you. At times, equity fluctuates and is more volatile than any other investment avenue. Do you still say we have to keep investing in equity? Is it still, especially during this scenario when people have lost a lot of money due to the market crash? Are you still a fan of equity?
Okay. I may have to share my screen to answer this. Yes. So, is this visible?
Yes.
Yes.
Okay, here what I would like to tell you is, okay, equity fluctuates. We all know that. Just to take you back through like what exactly has happened in the Indian stock markets. Here in the 1980s, we had 3 years of continuous droughts wherein the markets were like kind of flat. Here we had the Harshad Mehta scam back in 1992 where the markets tanked by 50%. Here we had 3 events. We had the 9/11 terrorist attacks, Ketan Parikh scam, and the tech bubble. Here we had the global financial crisis where the markets tanked by 60%. Recently, we had the issue with the COVID, wherein the markets fell by almost 35% in 40 days. So we can see this. This almost looks like joke falls, right? Wherein you see a 90-degree fall. We have made that recovery, but I do not really know how long it will last. But if you look at the entire graph, the market fluctuates. Yes, it fluctuates, but if you see the graph, it keeps going up in the long run. This is the Indian graph, and this is of the US stock markets in spite of the fluctuations. And this is the Great Depression, where the markets fell by 89%. But if you look at it, over the long term, there are no fluctuations. The markets keep going up in the long run. So the message I would like to tell you is, do not invest all your money in equity. When you are investing, you can invest, let's say, a portion of the entire idea is asset allocation, wherein a portion of your money has to go in equity, because equity over the long run will generate wealth. Otherwise, our story will be like that little Thai boy wherein he wanted to buy that telescope but was not able to do it. Also, when it comes to equity, there are fluctuations, right? How do we avoid it is by investing systematically so that we can cut down the risk. I would still go with equity because though it fluctuates over the long term, it beats inflation over the long run.
Right. Thank you, Vionel. My next question would be to you, Sapna. We have spoken about mutual funds, equities, stock markets, and quite a few people prefer to invest through life insurance. So is insurance not an investment as per your opinion?
I purposely did not mention in the short session that I did at the beginning is because insurance is not an investment. Okay, insurance is not for creating wealth. It is just for protecting yourself from financial disasters that can happen in life. Now, when it comes to there are different kinds of insurances. For example, two insurances are very important for an individual: health insurance and life insurance. Health insurance is important for everybody. Okay, a minimum of 3 to 5 lakhs is important for everybody in an Indian context as such. But most of us, when it comes to insurance, when they look at it as an investment, they look at life insurance. And we have n number of life insurance policies in the market. Now, all those policies, okay, as an investment are good for the investment company, sorry, for the insurance company and the agent who is selling it to you, and not to the investor. Okay, most of us are forced to buy these policies. It's because there are good commissions and brokerages that the advisor would get, and the company would make good profits. When it comes to returns on these insurance policies, what happens is, if you actually go to Google and make your research, and it is easy, very easy to find the data, it may not even beat the returns of our FDs. Okay, even the safest of the investments that we have, the returns may not beat even that. Forget inflation. Okay, so ultimately you are not going to be actually creating wealth out of such investments. So when it comes to life insurance, only kind of insurance that an individual should have, that too, if an individual has financial dependence, please note this name, that is pure term insurance. You do not get any returns from this particular insurance. What it does is only protect you from financial losses that you'll face in the future. So the only kind of insurance that you have to look at is pure term insurance. When it comes to health insurance, there might be people who are employed where your company is paying you, giving you a cover of health insurance. In spite of having the cover, your family should be covered with a private health insurance. You can calculate yourself, but ideally we would say, as a thumb rule, go for not less than 3 to 5 lakhs for your family. And you can go for something called as a family floater insurance for the whole family, where you can add husband, wife, and 2 to 3 kids instead of having individual health insurance policies. So
Right.
insurance is not an investment.
Right. So let me just add a couple of points on insurance. While every earning individual, it is very important for them to have a term life insurance, because term life insurance would replace your income if you were to leave earlier than what we expect you to. So if you pass away during your working life, your family is depending on your income, and they have a set lifestyle which would get highly impacted if you were to pass away and if they were not going to get your income going forward. So it's extremely important to get yourself a term life insurance, whereas the other money back insurance policies are not an investment policy. Okay, they don't help you get rich or accumulate wealth. However, I have a slightly different opinion from Sapna, in which I would say, if you want to just save money, right, which will get you returns something better than a bank saving account, maybe close to a bank FD, then the traditional policies, the endowments, are still fine, because they give you an ATC tax benefit. The returns are also tax exempt under section 1010D, and you also get about 10 times the premium you pay as an additional life cover. But first you need to get yourself a term insurance. And if you are a person who's risk averse, you do not want to invest in risky instruments, then some amount of it going into traditional insurance is still okay. But you should remember, that's not an investment. It is just at best a saving, which would give you a little over than your saving account. Maybe right now savings account crashed to below 3%. So these traditional products tend to give you about 5 to 6%. So they are tax friendly as well. But remember, they are not investments. They're at best called savings with a little bit of insurance component attached to that.
I prefer to agree with you, on this particular point, that even when you compare it to savings, you should not be going for investments in insurance. That is because of expenses. There are a lot of expenses. For example, in case a policy costs you 1,000 rupees, and the expenses can be as high as 30%. So flat, you are losing those that investment amount, which is the cost. Your 1,000 rupees now becomes 700 rupees, and from there you are getting 6% of returns. So where are you going to reach? And what we are not considering here, which is very very important, is the inflation. And if you're talking about even if it is about 10 to 15 years, if you want to invest in such insurance policies, if it is giving you 6% and the inflation rate is 6%, then your actual return is again back to zero. You'll be better off putting your investments in your FD, or maybe even better is putting your money in savings bank account, even if it is giving you 2 or 3% returns. And coming to tax, always see to it that tax should not be the criteria for our investment. Okay, in case if it is an additional quality of an investment that is giving you an tax benefit, how much can you invest in? ATC, it is up to 1,50,000 is what you can save. If you are in the 30% tax bracket, you can save up to 48,000 a year. But just to save 40, 40 maybe up to like 50,000 rupees, just to save that, do you want to really invest 1,50,000 in a bad investment? That is the question.
Again, the charges that you are talking are pertaining to unit-linked insurance plans. So if you say invest about 1 lakh in a ULIP, which is of course investing in certain funds which are similar to mutual funds, there are about 4% of charges. So eventually only 96,000 rupees out of that would go into investments. But the charges are not for regular traditional plans. There are plans where the returns are fixed right at the beginning, and it's a bond where you would get, say, 5.8 to 5.5 or 6%, whatever. Different companies have different products. So these are totally tax exempt returns. So even after 10 years, when you get your accumulated amounts, this will be totally tax exempt as per section 1010D. So there are a few individuals who are okay with 5 or 6%. Again, as Sapna said, it will not beat inflation, but to beat inflation, you have to put it elsewhere. You're not going to use traditional insurance policies as investment avenues. If you want your returns to beat inflation, obviously equities and mutual funds is the way to go. But if you want your returns with some additional health cover and your amount to be very safe, and if it's a dedicated long-term horizon that you want to be saving for. Remember, I'm using the word saving and not investing. If you want to put your money into that and say after 10 years, you get some amount, and if you calculate backwards, you would have just received about 5 or 6% of returns on your saving, then these products are still some products that customers do like. Some of them do prefer. Right. So moving forward into the next part of the
Sandeep, there's one question from Mahima Bhatt.
Okay, we'll take the question.
Yeah. So what she says is, what about the risk factor involved in equity investment compared to the insurance as such? Okay. Equity is risky. There is volatility. That's always there in the short term. Okay. Equity always grows over the long term. But if you're investing or so-called saving in an insurance product, it will be like that Thai boy. So you keep putting aside small monies, which will grow at, let's say, 5.5%, 6% as such, slightly better than your bank savings account. Where will you reach? Will you be able to reach your goal? So that's the question. So if you do not want to take the risk, and if you are self-satisfied, okay, I'm happy with these kind of returns, let's say the 6% returns, okay, go ahead with that. But equity always grows. There is no risk over the long run. Okay, if you look at 10 years and above, 15 years and above, 30 years and above, there is no risk. Look at any stock market. Yeah, I hope we've answered your question, Mahima.
Okay, I've got another question which just came in some time back. It's a very basic question. In fact, maybe I'll direct this to Vionel. We speak so much about mutual funds, right? And debt mutual funds, equity mutual funds, hybrid, and so on. But what if someone doesn't even know what is a mutual fund? So how would you teach someone who's absolutely new to this? What would you tell them? You're muted. You're muted.
Yes, I would definitely not say mutual funds are subject to market risk. Please read the offer document carefully before investing. So that's not the thing I would say, but I'll just take up a slide wherein. Okay. I'll give you an idea of what exactly is a mutual fund. Let's say we are the investors here. Just like you and me, there are so many investors. We may not have access to the markets. Let's say we have a debt market, we have the equity market. We may not have the time, we may not would like to put in the effort, or we do not really have the skills to go and negotiate in the debt markets or the equity markets. So let's say like I want to invest 5,000 rupees a month. There is another, like let's say Sapna wants to invest 10,000. Sandeep wants to invest 15,000 per month. Elston, let's say 20,000 a month. Let's say we want to invest. So what we do is we go to a mutual fund company. What a mutual fund company does is it manages money. It's also known as asset management company. If you ask me what is the role of a bank, what they do is they borrow money and they lend money. But what does a mutual fund do? A mutual fund manages money. So we all contribute. Let's say Sapna wants to invest for an emergency. So what she has to do is she has to go to the mutual fund and she has to choose a debt product or a liquid product of that mutual fund. Okay, so she can park money for emergencies. Let's say Elston wants to invest for the retirement. So when he is investing in mutual fund, he has to select the equity product. So there are multiple products, but this is just a big idea of what a mutual fund is. And your money, remember, your money is not with the mutual fund. Your money is in the name of the trustees. So if we are investing in mutual funds, the mutual fund is only managing your money. The money is held by the trustees. And to give you an idea, the money is in the markets held by the trustees, and it's held in a custodian bank, which is independent of what the mutual fund company is. And ultimately, we have a regulator called as Securities Exchange Board of India, who looks after all these things, a regulator. So we can be assured, because the kind of mutual fund structure that we have, it is very transparent. So let's say you're putting your money in the HDFC liquid fund. So we are very clear as to where a liquid fund is investing their money. So it's quite transparent when it comes to a mutual fund. So based on your objective, a mutual fund, what people think is we are investing in mutual funds. No, but there are so many schemes based on our objective, and based on the mutual fund objective, we need to match that and then go about our investments.
Okay, we'll go ahead and take some questions from the audience who have sent in some questions. Let me quickly go through the questions. Elroy Saldana says, I would like to know in the long run, correcting inflation, which one would be better investment, real estate or mutual funds? Of course, real estate requires registering and paperwork costs. Considering all that, which one is better? Sapna, would you like to take this?
Yes. Now, when it comes to investments for the long term, only two things beat inflation. Again, the question was particularly about investing, choosing an investment which beats inflation. Only two things beat inflation in the long run: stock market and real estate. And as I explained in the session, for a for a layman, when it comes to real estate, a house is a must, and it should not be considered as an investment. And when it comes to additional purchases of real estate properties, like maybe a land or a house or another property, if you are an expert, if you understand real estate, if you can manage the cost, maintenance, and all those things, if you are very confident about it, by all means invest in real estate. No problem with that. But when it comes to investing in stock market, and for example, let me give you an example of buying a apartment, a 2 BHK house apartment in Bangalore, which would cost you 40 to 50 lakh rupees. Okay. Now, in case you are only able to save around 20 to 30,000 rupees in a month, will you be able to buy that house or invest in that house which costs 50 lakh rupees? Again, you have to go for a debt, or you have to take loan from the bank where you have to pay interest. So that is why, you know, real estate may not be an ideal investment. Secondly, stock market, we may not be experts in choosing which sector to buy, which company to buy, how to invest, how to manage. And what happens is most of the times we get into trading, we start speculating, we become greedy. We buy when markets are going up, and then when the market starts falling, we fear. What happens is we are diverted from our goals and from our investment goals, and we are not actually sticking on to our investments as such. It is very tempting when one of the companies that you buy has given you 200 times returns, you would just exit. What we are trying to tell you is invest for the long term and make systematic investments. If you are earning 40,000 rupees, if it is 10,000 that you want to invest invest for your retirement, how will you manage buying those stocks in that 10,000, or how will you manage buying that house without additional loans? What you can do is go for mutual funds. In mutual funds, via SIP, you can invest in something called as an index fund. Uh, you can go for Nifty Index Fund, which has a portfolio of top 50 companies of our economy. Okay, Nifty Index Fund. If you want to still further diversify, go for the Nifty Next 50 Fund. It will invest in the next 50. So with just not even 10,000 rupees, just with 1,000 rupees a month, you can be investing in a portfolio that has 100 top companies of our economy. What can beat that? Have I answered it?
Cool. Going forward to the next question, Elston, let me direct this question to you. It's from Sharmila Kundar. She wants to know, how do I know which mutual fund scheme I should invest in? There are so many of them, of course. Based on what criteria should she select the mutual fund scheme?
Okay, let's put it this way. So I have fever, what kind of medicine do I pick up? Or I have some kind of ailment, what kind of medicine do I pick up? A doctor will be able to guide. They'll be able to check your financial status, your financial health, and then guide you. Similar way, a financial advisor will be able to do that. Okay, a financial advisor can also be called a wealth doctor. Okay, so now there are a lot of mutual funds. There are large cap funds, there are mid cap funds, there are small cap, there are value funds, there are closed-ended funds, open-ended funds. I would start off with a large cap, probably a mid cap, have index funds. Okay, but this is more general. Okay, I would depending on your time horizon. So if you're looking at 10 years and above, only then invest into equities or equity mutual funds. But kindly consult your financial advisor, because he would know what suits you better than me.
Right.
Yeah.
So let me take a couple more questions if there are any. Okay, let me go to Q&A. Okay, an anonymous attendee who hasn't shared the name would like to know if investing in mutual funds through apps like Grow. Okay, there are multiple apps or websites through which you can apply. Are they safe or not? Vional, what's your take on that?
No, at the moment, I wouldn't really want to make a comment on it, but if you want absolute safety, what I suggest is you can directly visit the mutual fund website, and there you can do transactions. So that is the best place to do it. We may have applications. You can go through it, but the best thing I suggest is it's advisable to directly deal with the mutual fund website, because you can hold them responsible. They are pretty much regulated, well regulated. So when it comes to these misappropriation funds and all, is like very extremely like I don't see any risk when it comes to directly dealing with a mutual fund itself. So that's the best option I would suggest.
Okay, another question from Prasanna Alva. Do you have any suggestion for NRI investments, especially when the situation with job security is not very good at the moment? Sapna, would you like to take that question?
Okay. For NRIs, when it comes to investments, you need to ask yourself, are you going to settle in the country where you're working, or are you planning to come back to India? And when it comes to investing, if you are working in countries like Canada or some states in the United States, or it also depends on what is the taxation and things like that. Now, let's not get into taxation, but ask yourself, do you want to come back to India? Okay. In case your answer is, I want to work here, have gather some, have some income, take it back to India, and I want to settle back in India, only then you need to start investing. And the criteria or the framework of investments remain the same. You need to have an emergency fund because you are an NRI. You may need to have higher emergency fund and maybe 2 emergency funds, one for your family in case they are not with you in the different country, an emergency fund in the currency of the country you are resided presently, and also a small emergency fund in India. When it comes to investments, again, if you do not have a house, you need to own the house. Not immediately, maybe you can go for it only when you want to settle back in India. Start investing in the stock market via mutual funds. You can have also general investment funds, and it depends on a lot of if you can give me a scenario, I would be able to explain better, mentioning which country, what is the is the income taxable there, not taxable there, is it okay to get your does the country of your where you're working, does that allow you to invest in the country, your native country? It depends on a lot of other aspects over here. But otherwise, you need to have an emergency fund, you need to have a general investment fund, and you need to have a retirement fund, wherever you choose to invest.
The next question comes in from CAMN Pi. I'll throw the question to any of you who would like to answer. Yes, what about debt market instruments like perpetual bonds and debentures over equity, especially when you see the risk perception of equities? Are they good?
When it comes to these perpetual bonds, it is what I suggest when it comes to debt instruments. The best thing what we need is to diversify. It is highly risky if in case we invest in like one company. So the best option is to diversify. And when it comes to debt instruments, one of the best ways to diversify is through a debt or a liquid mutual fund, wherein you get whatever money we invest, it gets diversified across like 70 to 80 securities. So there is, when it comes to the risk of default, it is extremely low. So debt is good, but it's only for your short-term requirements to park money for emergencies. But when it comes to for the long term, if you want to compare it with equity, I suggest for the long term, equity would beat inflation over the long term, and it would give you higher returns than what a debt product can give. Without and you do not really have a default risk when it comes to equity because you're diversifying across several securities.
All right. Another question from a person who hasn't named himself. They asked, "What about bitcoins? Will they be popular and profitable in future?" Elston, you want?
Yes. One question: Are they regulated? Who is the regulator for bitcoins? Do you want to lose your money? Do we know the founder of Bitcoin? Is there a face to it? Yes, people talk about Bitcoin. They made so much, they've lost so much. The Bitcoin value has risen 100 times, 200 times. Yes, but where is the regulator? Let's say you put money in ABC Bank, okay, which is not regulated by RBI. Are you willing to lose money? For example, your banks, your mutual funds, your stock market, your insurance, they're all regulated by different regulators as such, but Bitcoin doesn't have a regulator. So that's an open question.
I would
Yeah.
I would like to add on to it. Let's say when it comes to Bitcoin, maybe we saw the prices of Bitcoin shooting up and then falling again. The one question is, why does the price of Bitcoin go up? And if you reflect on this question, you realize that because people are buying. Why are people buying? Because the prices of Bitcoin is going up. Why is price of Bitcoin going up? People are buying. When it starts falling, why are people selling? Because the prices are falling. Why are prices falling? Because people are selling. So it's that circle. If you question and ask, is it really an investment? Is it really an investment? I don't really think it's an investment because it does not produce anything. Like equity, it produces profits. Like let's say a business, it can provide profits. Let's say a land or let's say a commercial property, it can give you rent. But what can a Bitcoin give? Other than the price fluctuations, anything. So it is not really an investment. We can consider it to be, it's a medium of exchange. Yes, would be a medium of exchange. As Elson rightly pointed out, it's not regulated. But still people consider it to be a medium of exchange, but is it really an investment? So it's not really an investment. That's the reason we wouldn't want to go ahead and invest our money. But if someone wants to play and lose money, if they are interested to lose money, or if they want to make big money and then lose it all over again, then possibly they can try something on Bitcoin, and we may also receive a notice from the income tax department.
Right. So I open the floor to the audience to ask any questions. Let me quickly check if anybody wants to ask any questions. Vidyadhara S, you've raised your hand. I'm going to allow you to talk. I have unmuted you as well. Vidyadhara, are you there? Okay, I think Vidyadhara is not able to answer the question. If anybody else watching the webinar, if you've got any questions, please feel free to ping them right now. Nagabhushan asks us if what is preferable for a longer term, mutual funds or ETFs? What he means to say is regular mutual funds or ETFs. Sapna, would you be willing to answer?
The difference between ETFs and mutual funds is that ETFs can be traded in the stock market. Unlike mutual funds, you cannot trade with mutual funds in the stock market. You have to maybe invest and withdraw or do your redemptions from their apps digitally, or you need to visit their office or invest through an advisor. So that's the only difference. Otherwise, if it is an equity, if it is a gold ETF or an equity ETF, if you prefer going to the if you have a demat account and if you prefer investing systematically in an ETF, it doesn't make a huge difference as such. But when it comes to managing your investments based on your goals for short term, medium term, long term, you may not have the variety to choose, or you may not get the proper kind of ETF that matches your investment. When it comes to mutual funds, you have debt investments, debt mutual funds or liquid mutual funds where you can invest for your emergency, for your retirement. You can go for a Nifty, or you can go for the index funds, and for your medium term requirements, and for the to invest for your children's education and things like that. You can go for the hybrid funds, which hybrid fund is a combination of equity and debt. That option may not be available in ETF. So it's only about how comfortable you are managing your investments and actually doing those investments. Mutual funds would be more, the mutual funds has more, what do you say, it can be very easy for you to manage your investments. It's not only important for you to start your investments. What is more important is to also get proper service on your mutual funds, which mutual funds will be able to provide you better than maybe opening a demat account by yourself and doing things by yourself. The question boils down to, when you fall sick, are you comfortable going to the medical and buying medicine for yourself and treating yourself, or is it better go to a doctor and get it diagnosed? So it's always better to take professional help, which mutual funds, in terms of investments, mutual funds would give you the professional help that is required.
Another question coming in from an anonymous attendee, Elston, if you could answer this. He asked you to name the best mutual fund companies.
It's like picking the best medicine as such. So whether to buy medicine from Dr. Reddy's or Lupin Industries or GSK Pharma. Okay, there are about 42 mutual fund houses in India. As of I think 48 mutual fund houses in India. So instead of looking at which mutual fund company is better, it's better you stick on with, where do I need to put my money? My emergencies. Okay, where do I need to invest for my emergencies? My goals. Okay, my retirement. So based on that, look at a diversified fund. So every mutual fund house will have a good fund with them. So
okay, Abhishek has a question. He asked if trading through apps like Olymp Trade or other apps safe.
Are these equities?
Yeah, the question is pertaining to, I think, buying and selling of stocks and shares, which is not the focus of our discussion. However, if you would have any opinion, any of you could let us know.
Yeah, we haven't tried Olymp Trade as such, but other apps like probably you have your Angel Broking, your Motilal, your Sharekhan, your BNP Paribas, and things like that. So there's nothing wrong with those as such. But Olymp Trade, I'm not very sure what exactly it is. I haven't tried that yet. So
Neither have I tried, but if I were you, Abhishek, I may not risk with unknown or not well-known platforms because you may be aware of what happened with Carvey stockbroking about a few months when they were using the amount in the demat accounts to invest elsewhere, and a lot of money was being stuck. So you need to be careful. Probably just go to your your broker's website. Say you have bought shares through SBI Capsec, so maybe buy and sell from there, and maybe Zerodha, maybe HDFC Securities or ICICI. But personally, I don't have much of a good impression about many new apps and many new platforms coming up. You never know what surprise they can give you. However, I have not had any personal experiences. I personally trade on my HDFC Securities app and website. And I also have a Zerodha platform as well. So I'm happy with them. Let me go ahead and see if we've got some more questions. Okay, another anonymous attendee would like to know if they have any equity investments right now, should we sell or should we retain? Gional?
Okay, it's a good question, but ultimately it's important to know your objectives. It's important to know what you want in life. Okay, whether if this is not really speculative, because if you ask whether I need to buy or whether I need to sell, nobody knows where the markets are going. Okay, nobody really knows where the markets are going. It's ultimately to do about your objectives. You're very sure I don't need the money for the next 10 years. Okay, stay in equity. Okay, but let's say you may need money after 6 months. So now you're taking a bet because nobody knows where the markets are headed. So if you want to, there is a risk. The markets can go up, it can go down. So the best thing is ask yourself and take professional help to come up with objectives. Okay, if you can come up with objectives and stick to your time horizons and invest accordingly, great. Otherwise, I suggest you can reach out to any of the financial advisors and then maybe help you plan out things. But when it comes to I have equity, whether I need to buy or sell, nobody really knows. It's just like flipping a pie. in the short term, but over the long term, as I already mentioned, the markets can keep going up in the long run in spite of these gigantic or dramatic events that have taken place in the past.
Yeah, just adding to Yonel's reply, if you have invested for the last 10 years and your goal has come, yes, please withdraw and utilize it for your goal. So your goal is more important than your investment. So withdraw, use it. But if you are thinking whether equity is risky or safe and things like that, invest for not less than 10 years. Okay, you will see the returns. Okay, so your goal is important. So goal about 10 years, yes. Or now if your goal is you've achieved your goal and you need the money, utilize it. But if you've done an SIP for the last 10 years or invested over the last 10 years, I'm sure you would have not lost money. You would have definitely made money. Maybe slightly lesser because markets have fallen drastically, as we saw in the graph, but slightly or above average returns as such. So I'm sure you would have beaten inflation by now. Yeah.
To share my opinion on this, it's not the right decision to exit when there is a market crash because you're adding to the fear factor, and that's where many people lose money. You might as well want to stay invested until the markets recover and it once again reaches a bullish trend. If you have already, as Elston said, if you already accumulated enough returns on your investments, and if you need the funds, yes, you can dip into the funds. But if you are not needing the funds right now, why would you want to remove your investments when they have already dipped? In the month of January, February this year, the markets were at an all-time high, and around March, mid of March, they crashed more than 30%. So many people, and when does a stock markets crash? When people are selling, when there is panic gripping the markets, people are selling and the prices are going lower and lower. This is a time to invest more, so to be opportunistic. We spoke about, in fact, in Sapna's presentation, there was a quote by Warren Buffett. There is another very interesting quote by Warren Buffett. He says, be greedy when others are fearful, and be fearful when others are greedy. So what has happened now is that people are fearful, right? They have sold, the markets have come down. You can see that yesterday, day before, and the day before that, markets kept crashing, and today there was a small recovery. That's again because people are, the last 3 days, people were panicking about the surging cases of COVID-19 in India. But today, the opportunists have invested some money, and that's why the markets have again risen a little bit. So there will be volatility, but eventually it will raise again. And in the last 3 major market crashes, you would have observed, or you may even go back to the data, within a year and a half, it comes back to the previous high that the markets had touched. So if you have to go back by past data, maybe somewhere around the mid of next year is when you can expect it to reach the previous levels. But that's again very uncertain. The markets are very uncertain. So if you do not need the funds, you might as well stay invested. And every time there's a market crash, if you have some sufficient funds, you can still keep investing a little bit. Don't put a big lump sum at one shot. If you hear that the market Sensex crashes by 1,000 points, don't just dump all your money, because it may still further go down. So every time it goes down, try putting some amounts and then just have patience for some time. Well, I think we're coming to the end of the session. We've been here about 90 minutes. Just taking one last question. 2 of them have similar questions, Prasanna and the other attendee, anonymous attendee. What is the best way to get all finance related advice if you're looking through the internet or any personal advice? And that's what all of us do, right? That's our profession. So Mr. Prasanna, you could get in touch with any of us. If you already know one of them, you could get in touch with them. All of them are investment advisors, or you could also get in touch with me. Anonymous attendee again wants to know where and whom to meet. All the three of my panelists are based in Mangalore. If any of you is in Bangalore, you can get in touch with me as well. I am Sandeep. And my website is my website is asheka.in, www.asheka.in. And my email ID is hello@asheka.in. And my phone number would be 99021 46723. That's 99021 46723. Sapna, Vionil, and Elston, how can they contact you in case they want personal advice?
At the end of the session, we will share our email IDs. I'll share
Okay.
the slide where I have put up all the email IDs so they can contact me.
You have a slide.
Yes.
Sandeep,
Okay.
can you give me 2 minutes wherein I just want to share something really important,
Yes.
addressing the question wherein as to where exactly they can get related information or the way forward from here. I'll just share my screen. A couple of important points. Now that we have come almost to the end of the session, see, if you want information, if you want knowledge, and if you want the kind of insights or wisdom, you need to have these things in order to be good at investing. Or the second best thing is you can take professional advice. So you can reach out to any of the financial advisors here, or if you know any financial advisors, you can reach out to them. But if you do not want to take professional advice, then you need to have the information, you need to have the knowledge, and you need to have the insights and wisdom. So if you want some basic knowledge, you can go to Franklin Templeton Investments. And there are these small videos when it comes to new to investing, new to mutual funds, and more about mutual funds. This will give you a basic idea about investments. But if you want to read a book, a good guide on personal finance is by Monica Halan. She's a financial journalist with LifeMint. It's a book on Let's Talk Money. It's very simple. It gives you a good guide on how to go about investments. But if you want wisdom, if you want insights, you have to read one of these books. It takes some time, but it's worth reading, because even if there are market falls, and if you have read this book, it gives you that strength to stay the course. So this is what I would, and finally, I would like to end with yes, about this. This is a strategy that all the participants can use in future. If the investment advisor, if you reach out to the investment advisor, or if you want to judge whether the investment advisor is talking in your interest or no, you can use the strategy. This is the product. Product is the least important. This is the mutual funds, stocks. You can have your shares, bank FDs, recurring deposits come under the product. If the investment advisor talks about the product, so if your conversation with the investment advisor is predominantly on the products, then remember, the advisor may not be talking in your interest. But if the advisor is talking about you, about your goals, then in my opinion, the advisor is talking in your interest. So this is one of the good ways to judge whether the financial advisor is talking in your interest or no. This is the thing that I would like to share with y'all. This can come handy whenever you happen to have discussions with financial advisors.
Right. Sapna, can you share the contact details?
Yes, I would like to just a minute, I'll share this. Now, I personally, when I attend a webinar as a participant, I usually take screenshots of the things which I want to remember in the future. So here I have put everything in one slide so that it is very easy for you to refer in the future. First and foremost, the thing what you need to do is assess your financial situation. And this is not a one-time process. You need to do it at least once in a year. Okay. First, ask yourself, how much are you spending for your past? How much are you spending for your current self? And how much are you paying for your future self? what are your EMIs, reduce your EMIs. If you are spending more than 50% of your take-home income, please control your expenses and please control your expenses and always start saving and investing for your future. And how do you save and invest for your future? Always have goal-based investments. As I think Yonel has already shared, it's very important to have a plan. It's okay if you don't have the money to invest right now. It is important to have a plan than having the money and not having a plan to invest. Goal-based investing is very easy. Just divide your requirements into three things: emergency fund, general investment fund, and retirement fund. All your children's education, your family vacations, family functions, all those things, your dreams and aspirations, starting money to start that business, everything comes under the general investment fund. See to it that you at least invest 15% of your monthly income. Where to invest? You can go for, if not for stock market or real estate, you can go for equity and debt mutual fund. And for an emergency, out of all the three, if you ask me which is compulsory, it is an emergency fund. You need to have at least 12 months expenses, and you can invest in something which is very safe, that protects your principal, and which is very liquid, which means you can convert it into cash without loss of value and time. You could go for either a bank fixed deposit or a liquid mutual fund. And if you have not yet started planning and investing for your retirement, please start right away. Okay, minimum of 10% of your income should go into your retirement, and you can choose to invest in a diversified equity mutual fund, or you can go for index fund. So since most of them asked for our contact details, we have our email IDs here. The moderator today was Sandeep Narayan, and panelist myself, Sapna Shenoy, and the other two, Yonel D'Souza and Elston Menezes. Over to you, Sandeep.
Right, Elston, Yonel, Sapna, thank you very much. It was very informative. I absolutely enjoyed moderating this session. I'm sure the participants also derived a lot of information, and they would also be happy to get in touch with each of you, or probably even me. Prashant, thank you very much for organizing this seminar and this webinar, and looking forward to doing more such workshops for the benefit of the common public. If anybody else has to say anything.
Sandeep, just to add to it, we are also planning to have detailed sessions in the future, maybe like how to do on financial planning or equity markets and investing in stocks and things like that. If you are interested to join future webinars and workshops, please feel free to write to us. You can write to either of us.
The three of them are also trainers, so if you want them to deliver training sessions at your companies, your societies, institutions, wherever, they'll be happy to do that. Am I right, guys?
Yes.
Yeah. Great. Looking forward to meeting all of you once again in the near future. Thank you very much, and I will end this meeting. Bye, Sapna. Bye, Yonel. Bye, Elston.
Thank you, Sandeep. Bye.
Thank you, Sandeep.
And last but not the least, the audience. You've been very patient since the last 90 minutes, for the last 90 minutes. So thank you very much. We appreciate it. Okay then. Have a great evening. See ya.